Welcome to Mortgage Mondays.
Hi, my name is Vincent Miranda. I'm from Keller Williams Clear Lake, and today we have
Fransisco Cuza. I am a mortgage advisor from Fairway Independent Mortgage Corporation. And
Alex Marquez. I'm a realtor here at Keller Williams Clear Lake. Vincent, can you tell me a little bit about yourself?
Absolutely, I'd love to. So before I was a realtor, I was in the hospitality industry. I live and work in Galveston. I also work in the Houston area as well. But I worked at some of the major hotels and restaurants in Galveston. So my hospitality background, I bring into the real estate industry, and I make sure that my clients are taken care of the way that I would back in the hotel business. Fransisco, do you want to talk a little bit about yourself?
Of course, thank you. Nice background, Vincent. Just like you, I actually come from a different industry. I come from the medical industry, and I brought that passion of helping people into the real estate and the mortgage industry. And so now, I enjoy doing mortgages. I am a fully bilingual Hispanic individual. I was born and raised in Puerto Rico with Cuban parents. What about you, Alex?
Originally from New York, but definitely called Texas home for a really long time now. And before real estate, I was in the banking industry. I really enjoyed helping people there. And when I got the opportunity to work in the real estate world, I got to do the same thing, but for people buying and selling their homes. And I've been really enjoying it the past few years. Thank you.
Well, Alex and Fransisco, I'm happy to have y'all both here.
Well, thank you.
To be able to help anyone who's watching this video. So first off, I want to talk about there are different products out there on the market if you're a home buyer. But today we're going to focus on renovation loans. And we have Fransisco who's going to talk about this. He's going to give you all the ins and outs of what it takes to buy a home and buying it if you're wanting to renovate the house.
Well, thank you, Vincent. Yeah, renovation loans are a great product. It's another tool to have when you're a home buyer, so that you have more options, particularly in a market like where we're at right now, where inventory is very low. The turnkey homes are flying off the shelves. And so this brings or gives the buyer a different opportunity. If the buyer qualifies for a mortgage, we can very easily convert that mortgage qualification into a renovation loan product, which very simply, without going into too much detail, is basically that product allows you to have a renovation budget that is calculated into your purchase price as well. So the entire loan amount is basically purchase and renovation in one loan. So it creates and gives the buyer more options when they're looking for their properties.
Okay.
Yeah, that would come in handy because lately I've been having a hard time finding my buyers these move-in ready homes in the price range that they're pre-approved for. So it's good for people to know that there's options out there.
Perfect.
Exactly. And sometimes a first-time home buyer might even want to buy a home to make it their own, right?
That's exactly right.
Exactly.
And a first-time home buyer can actually have a renovation loan product.
Exactly.
Fransisco, what are the requirements of an FHA 203k?
Great question, Alex. The requirements are, well, first, we need to pre-qualify our borrower. We need to have a contractor in place so we can get bids. And that's as simple as that. That's pretty much it.
Great.
Now, is there an application process that the buyer has to do? Is there any documents that they have to provide?
Of course. Yeah, so like any loan, any mortgage, they will have to go through the pre-qualification process. So that means filling out an application and submitting the documents that their lender are going to require for them to submit so that they can review and verify their income, assets, and credit.
Okay, great. Okay, so let's just say if somebody reaches out to you, Fransisco, and their credit might not be that good, or say their financial situation, they might not know what their debt to income ratio is. What do you recommend to the buyer on how to fix these things?
Perfect. So we do have in-house, we have a tool called the credit tool. So we basically have a credit repair team that will help borrowers if they have, bad credit. We can certainly try to guide them in the right direction so we can get their credit improved, so that ultimately they can qualify for a purchase. As far as the debt to income ratio, we help them with the calculation. Debt to income is basically you take somebody's debt, any monthly obligation, and then divide it by the income, the monthly income, the gross monthly income, and you get the debt to income ratio.
Good. I feel like sometimes some buyers go only based off of credit score, right? But that's not the scenario. It goes
Correct.
by credit score and debt to income ratio.
Correct. Really, those are two components. If we're going to talk about that gamut of pre-qualification, we're basically looking at income, assets, and credit. So credit basically is their FICO, and typically most mortgage companies are going to use the middle FICO score, and if there's a borrower pair, we're going to use the lower middle.
Okay.
So that's the FICO score, and then within the credit, we're going to see their monthly liabilities, or basically what are their monthly payments. What do they look like? What does their card note look like? Do they have any personal loans? Do they have any student loans? Do they have any alimony payments? So all that's going to fall into monthly obligations, and then we compare that to their monthly income, which is basically gross monthly income. And if they're W-2, it's basically looking at W-2s and pay stubs and figuring that quantity out. If they're self-employed or they have businesses, then we would have to look at tax returns to figure the income out. And then lastly, we'll look at assets, which are basically how much does the borrower have in liquidity for a down payment and closing cost. So when you look at the entire picture, that's where really the pre-qualification comes into play, because you can have, let's say a 750 credit score, but if your income is, $1,500 a month, it's going to be very difficult to qualify for, let's say, a $350,000 house. It doesn't make any sense. Mathematically, it doesn't work. So most people think, yeah, if I have, 750 score, then that means I can purchase everything. And that's not the case. It could also happen on the inverse, where they might have, let's say, a 640 score, but they actually qualify for a very large purchase because they have the income and they have the assets.
Gotcha.
So you got to take the entire picture, and then that's where the mortgage officer, is very valuable in determining where are they and what can we do.
Gotcha.
Okay. Francisco, if I connect you with one of my buyers and they didn't meet one of these requirements, what could they expect from you?
Advice.
Okay.
It's basically telling them, we're weak in, let's say, going back to those three, we're income, assets, credit. We're maybe weak in, let's say income. Advise them, okay, is there any other means of income that you haven't told me? Perhaps do you have a rental property? Are you receiving any alimony money that you forgot to tell me? Is there a possibility of you getting a pay raise within the next couple of weeks or months? If it's credit, we have the credit repair tool. If it's assets, it's basically advice on, hey, maybe you may be too much debt. You may want to kill some of that debt down or sell some stuff to get more assets. So it's basically trying to play with the numbers and get them to where they need to be.
Awesome.
Got you. Thank you. So going back to the renovation loan that you were talking about earlier, what is the timeline? Like, how long is somebody able to move into the house while the work's being done to it, or can somebody even move into the house while the work is being done to it?
It's a great question. So it depends, right? If the property is deemed by the appraiser, or sometimes we use a HUD consultant, and they deem the house uninhabitable, then basically what's going to happen is the project has to be finished, and then they would get a certificate of occupancy, and then they would be able to move in. So it's very similar in that regard to a new construction project. The cool thing about that is, in some of these renovation loan products, you can actually roll in the first 6 months of payments into the loan. So basically, they're not making a single payment until they actually move into the property.
Gotcha. Okay.
And most of the products that we offer basically are within the guidelines of Fannie Mae, Freddie Mac, or FHA, and the most that the project can last is 6 months. So which is why
So you're saying you can purchase a home, get the renovations done within 6 months, and then you close on the home after 6 months, and that's when you make your first payment?
So we would actually close on the loan before the project starts.
Okay.
So basically, we close on the loan. We basically cash out the current seller, and then there's an escrow account for the renovations.
Got you. Okay.
So from closing, at that point after closing, you have the new owner, which is our buyer, owning the property and controlling the renovation, and then they move in after the renovation.
Gotcha.
But they don't make a single monthly payment from closing to moving in.
Wow. Okay. Well, that's good information. Alex, do you have anything else?
I don't think so.
Okay, I've got one more question.
Okay.
So what is the worst thing that a buyer can do while they're under contract in a house?
Very, very good.
Because I feel like this is very important, and anybody out there who's buying a home should know this.
It is very, very, very important. There's actually a couple of do nots, and do nots are: don't try to get a new credit line, meaning don't apply for a credit card, don't buy a new car. Basically, don't change anything in your financial picture because it may change your pre-qualification, and we may go to closing and then figure out now, hey, sorry, we don't qualify for this loan, we can't close. I'll paint it to you this way, and I'll go back to my medical background. It's like, what is the worst thing somebody can do after somebody takes an x-ray of their arm, and that will be breaking their arm? Because now you take a new x-ray and now you see a break that you didn't see before. So that's basically what a borrower is doing, right? You know, we have a nice picture and it looks pretty. It's a pretty picture. You're pre-approved. Let's not shake anything. That would be like an earthquake. So you don't shake anything, and then after you're closing, go get the furniture that you want. Go do this, that, and
if you close on the 30th of the month, and go buy a car on the 1st of the next month.
That's right. You
So
do it after.
you review everything in the beginning and again at the end, correct? Right. Okay.
Right.
So I'll tell you a funny story. I bought a house in Galveston 6 years ago, and I actually did that. I bought a truck while I was under contract on a house. Luckily, nothing changed financially. Like, I was still able to buy the house. But my realtor was like, "Why did you do that?"
Yeah. So because you're adding, basically, think about it. You're adding, whatever that note is. You're adding whatever 250, 400, 500, whatever that number is to your liabilities.
Yeah.
Then if you were tight on DTI,
that's it.
That pushes you over.
No, luckily it didn't change. But luckily I was still able to buy the house. But yeah, it's a true story.
Well, thank you, Fransisco.
Awesome, thank you guys.
Yeah, thank you guys for being here, Alex. Thank you too.
Thank you for having us.
Hopefully we'll see you guys again. We're planning on doing these videos on Mondays. Next time we'll have this video, we'll talk about more of maybe VA loans or first-time homebuyer loans. So make sure to tune in and watch us again next time. Thank you so much.
Thank you.